What does a murmuration of starlings have in common with the Nasdaq? In both, you see complex, intelligent-seeming behavior emerge from individuals following incredibly simple rules. A starling doesn't see the whole flock, it just keeps a certain distance from its neighbors. Similarly, the earliest trading algorithms didn't try to understand the economy. They were just simple if-then statements, reacting to immediate digital neighbors in a sea of data. If a price drops by X, sell. If volume surges by Y, buy. Your brain is a pattern recognition machine. It's so good at it, it finds patterns even when they don't exist. You see a face in a cloud or a man in the moon. This is called pareidolia. For decades, human traders have done the same with market data, identifying formations like a head and shoulders or a cup and handle. But are these real predictive patterns, or are they just financial constellations in a sky of random noise? The data is often ambiguous. An algorithm doesn't see a head and shoulders. It doesn't see pictures at all. Instead, it perceives the market as a point in a high-dimensional space. Every variable, price, volume, moving averages, order book depth, is another dimension. The pattern it finds might be a subtle, recurring geometric relationship in 50-dimensional space. It's a structure completely invisible to the human mind, which struggles to visualize beyond 3 dimensions. The machine isn't just faster, it is looking at a different reality. Some of these patterns exist for only microseconds. This created an arms race, not for better predictions, but for pure speed. Companies spent hundreds of millions of dollars laying fiber optic cables in the straightest possible lines between Chicago and New York. They built microwave towers to shave a few milliseconds off the journey by avoiding the Earth's curvature. In this world, the speed of light itself is a physical constraint, and the algorithm that acts a nanosecond faster is the one that captures the profit. Modern financial models have evolved from simple rules to deep learning neural networks. Think of it like a brain in a box. We feed it immense amounts of market data. We see the output: buy, sell, or hold. But the process in between, the reasoning, is a web of millions of mathematical weights and biases that adjusted themselves during training. We cannot truly ask it why. The oracle gives an answer, but it does not explain its prophecy. This raises a fundamental question. Do you need understanding to make a good decision? It's no longer one algorithm against a human market. It's a digital ecosystem. Thousands of different algorithms from thousands of firms are all interacting, trading with each other, and trying to outsmart each other. This creates its own emergent behavior. A flash crash, where the market can lose trillions in value and regain it minutes later, is not a failure. It's the natural result of this ecosystem. A sudden, cascading feedback loop of bots reacting to other bots, like a digital stampede. An algorithm feels no fear or greed, but it can be programmed to recognize the patterns created by human fear and greed. It can scan news headlines and social media for sentiment, correlating words like panic or crisis with market movements. It can see the massive volume of sell orders that signals a human panic. For the algorithm, our collective emotion is not a feeling, it's just another input variable. It learns to buy when our fear is highest and sell when our greed is most irrational, exploiting our predictable biology. But the machine has a critical weakness: context. An algorithm can analyze decades of pricing data, but it doesn't know what a company actually does. It doesn't understand that a tweet from a CEO can fundamentally change a company's value, or that a new scientific discovery could make an entire industry obsolete. Humans, for all our emotional flaws, are context machines. We understand the messy, unpredictable world that exists outside the data stream. For now, this suggests the future isn't man versus machine, but man with machine. In chess, the best players in the world are not grandmasters or supercomputers, but centaurs. These are teams of humans using computers. The human guides long-term strategy, provides the contextual understanding, and asks the important questions. The machine executes the tactics, sifts through billions of data points, and guards against emotional error. It's a symbiosis of intuition and calculation. Ultimately, this forces us to ask what a decision even is. When you choose to buy a stock, is it a conscious choice born of belief and analysis? Or is it just the output of the electrochemical signals in your brain, influenced by hunger, sleep, and fear? An algorithm's decision is simply the optimal output it can find from a given set of inputs. It hasn't chosen, it has calculated. And as the world becomes more quantified, perhaps the line between choosing and calculating begins to disappear entirely.
Monotony has grown fast. Nearly 2,700 people have watched in the last few weeks, yet less than 0.03% are subscribed. It would mean a lot if you joined by hitting subscribe. And again, thanks for watching.